All right, so for our discussion, we will talk about GST. GST, or Goods and Services Tax, is a value-added tax which is levied by the businesses, and it is passed on, okay, to the consumer. Okay, and the important thing here is to remember what is or how much is the rate. So the rate here, of course, given in the slide, Australia 10%, and then New Zealand 15%. But of course, in Papua New Guinea, we also use 10%. Okay. So how it works, okay, so you have, let us say in this case, timber merchant, and then they will sell the timber to the manufacturer, and then this one, the manufacturer will sell it to the retailer, and eventually that will land to the hands of the customer. Okay, so the tax is being passed on to the one who purchased the product. So just that series. Okay, there are two exceptions in Papua New Guinea. We have what we call exempt. Okay, GST exempt. Okay, so in Australia they call it GST free, and then input tax supplies. Wherein in Papua New Guinea we have what we call zero rated, okay, tax. So the main aim is to journalize. Okay, the main aim is to journalize the transaction. So we have when we purchase an item and we say it says GST inclusive. So take note, the word inclusive means that the GST is already included in the price presented to you. In this case, or shall we say we call it invoice price. Okay, the simplest way to determine that is invoice price. Okay, be mindful about the wordings. Okay, particularly when you are recording transaction. GST inclusive means GST is included, so which means you need to remove that. Okay, and GST exclusive, then you have to add that 10%. Okay, so in this case, if you look into the transaction when they purchase uh, tables, it says $440 GST inclusive. That means that the 10% is included there. So the price shown here is 110%. So 110%, you just have to remove 10% of that. Okay. So for inventory, that will be 10, of course, 10 tables multiplied by $400. Why $400? We remove that portion of GST. So to calculate that one, you can always do, okay, the invoice price multiplied by 10 divide 11. So in this case, $440. If you multiply by 10 and divided by 11, then you will have 400. For GST, easy, okay? So the invoice price $440 divide 11. As simple as that. You get the GST. Of course, the accounts payable or total price that you need to pay will be the invoice price, which is $440. Okay? So this is the journal entry for that. If there is a return, you just have to uh, debit accounts payable. Of course, inventory will be credited because you're returning the product. At the same time, you also have to credit GST. Okay? In this case, that is GST paid. As you can see on the previous illustration, we debited GST paid. We just have to reverse the entry. Okay? Clear? Now, for selling products, that will be, of course, if it is on credit, so debit accounts receivable based on invoice price. Okay, and then credit sales, remove the GST. How to remove that one? Same, invoice price multiplied by 10 divide 11. Okay, and then GST collected, that is a liability account. Invoice price divide 11. Okay, so you will have the GST. As you notice, cost of sales and inventory here doesn't have GST. Okay, it doesn't record the GST portion of that because you already recorded GST for inventory when you purchase it. So no need to do again and again. Okay? Sales return, basically you just have to debit the contra account. sales returns and allowance, and GST collected. The credited amount will be on accounts receivable, 500, in this case, uh, price, which is GST inclusive. Okay, GST inclusive. Discounts. Okay, if there will be discounts and you allowed for discount for your client, there will be GST portion of that. The GST portion of that will be based on, of course, the uh, amount which is should be exclusive of GST. When I say exclusive, you don't calculate for the portion of GST because that portion of GST should be calculated and separated under GST collected. Okay. Okay, when you're trying to remit, normally GST collected, which is a liability account, is more than the GST paid. Normally. But there are chances that it can be lower than the GST paid, which is an asset account. So, and in this transaction, we are trying to say GST collected is greater than the GST paid, which means we need to, in this case, opposite. GST paid is more than the GST collected. So we assume that we will be collecting cash. Okay? But again, normally GST collected or liability is greater than the GST paid. And also it is in practice that GST excess GST paid is not refunded, okay, by IRC. Normally, they will just tell you to carry it forward and then try to collect that or use that as a credit for the next GST declaration. Okay? It's not really useful that IRC will refund the money for GST. Okay? Unless you will cease or your business will cease to operate, then IRC will be required to return the excess GST to you. Okay? This transaction, same with the previous slide, we call it offsetting of GST. What we are doing here is the GST paid from our purchases and GST collected from our sales, we are offsetting. And this illustration is saying we will need to pay because the GST collected is greater than the GST paid. Okay? So that's a simple transaction or discussion on GST. So let's try to answer problem set A 4.8. Start on chapter 5 or on module 3 with regards to reporting and analyzing inventory. So the main focus will be on the inventory cost flow. Later we will have an exercise to do that. Okay, so just few things. In particularly on manufacturing business, we have different types of or categories of inventory. We have raw materials, work in process, and finished goods. This will be discussed on your management accounting. In that unit, you will have more details about this. Now, just an overview of how periodic inventory system different from perpetual inventory system. Perpetual inventory system is this is the one that we're doing, okay? And how it is different from periodic inventory system, they don't keep that regular recording of in and out of transaction, which means they don't have that second entry when you have a sale. Remember that debit cost of sales, credit inventory. And then what they will do is they will record purchases in generic. So which means when they purchase, they will use the word purchases. And then at the end of the period, they will adjust, okay, the accounts to reflect the inventory or the total cost of inventory on hand, and it should be recorded in financial report. So this is the key difference. As you notice, for example, if you purchase inventory on credit, in perpetual inventory system, we have this. debit inventory, credit accounts payable. But for periodic inventory system, we're using account purchases. Okay, purchases. Then for freight costs, almost the same, but in some instances in perpetual inventory system, I have mentioned to you last discussion, inventory can be used also. Okay. Purchase returns and allowances, debit accounts payable and credit accounts payable for perpetual system, but for periodic, accounts payable debit and then credit purchase returns and allowances. Okay. And then payment on account without discount, so debit accounts payable. And you can see here, discount received, same. Okay. So we will not go through that much on the discussion. Just comparing it. Sales on credit, as you can see here, we only have debit sales. So debit accounts receivable, credit sales. Same with periodic inventory system, but this debit cost of sales and inventory is missing or not applied in periodic. So that's the main difference. Okay. Almost the same with all except for that, right? Okay, to calculate cost of sales in periodic system, you have to record purchases of inventory, determine cost of goods purchased, and then you will determine the beginning and ending inventory. And then for that, you need to take physical inventory count or stock take, as you may be familiar with, and apply cost to items counted in inventory. Okay, so these are the titles that you can go through. Okay, and to determine net purchases, purchases less purchases returns and allowances. So we have net purchases, add freight in, then you will have cost of goods purchased. Then going through that one, this is how you calculate cost of sales. We have the opening inventory or beginning inventory, add cost of goods purchased. A while ago, I've shown to you how to calculate that one. Cost of goods available for sale, and then less ending inventory, we have cost of sales. Okay. In presentation of PL statement, okay, you can see the section cost of sales there in details or in detail. So we have opening inventory, add purchases, less any returns, add freight in. You will have cost of goods purchase, cost of goods available for sale, and then closing inventory deducted. You will have cost of sales. So in periodic, it's a much lengthy presentation of cost of sales, much detailed one. Okay, but for perpetual, because we are only using one single item for cost, tracing inventory and recording the cost, so the cost of sale will only be presented as one line item here. Okay, not unlike this, we have around 8, 10 line items. All right, so let's start our main discussion, inventory cost flow. We have different inventory cost flow. Specific identification is simple, okay? And it's applicable for inventories with high value, like diamonds or jewelry or sports car. Okay? So this high value inventory, you use a specific identification. How we are doing that? Remember that the journal entry debit cost of sales, credit inventory. If we're using a specific identification, you just have to calculate how much is the item, the specific item. So that will be your debit and credit. Okay. The problem will arise if you have multiple inventories, and it will be quite a lot for you to account for, and you cannot use a specific identification. Okay. So these are the methods that we will discuss. So we have first in, first out, or FIFO. Last in, last out, or last in, first out should be last in, first out. LIFO, and then average cost. Okay. So let's try this illustration here. So we have been given this information from Double Electronics. So we have inventory opening, we have purchases on these dates. Okay? And then of course you have sales. Huh? Then you have been told that you sold 550 units. Okay, so let's take note of that. The number of items that available for you to sell or goods available for sale is 1,000 units. Okay, and then it says you had been advised that you have sold 550. If you are using first in, first out, take note. If you're using first in, first out, the 550, the cost, take note, the cost of sale, the one that you will put in debit, cost of sale, credit inventory, will be coming initially from this first in, first out. So 100, take note, so you have 550 less 100, so 450, less 200 for 450, you still have 250, then 300, so it's enough, right? So there will be still 550 here remaining for closing inventory. So 50 plus 400, 450, correct? 1,000 less 550, 450. Clear? Am I clear on that? Okay. So here, your cost of inventory will compose of this opening inventory, and which is unit cost $10. Another one is 200, which will cost you $11. And part of this 300, which is 250, cost will be per unit $12. Okay, so clear on how we will get the cost of sales. So applying first in, first out. Okay. So this one is not really detailed, but I'll show you. So I'll just use this board. So you have 100 a while ago, multiplied by 10, 200 multiplied by 11, and then 250 multiplied by 12. Is it 12? Yes. So here, how much will it be? That will be 1,000. This one is 2,200, and this one will be how much? It will be calculated. That will be 3,000, right? So if you get the total, 6,200. Okay, 6,200. You can see here. That is the cost of sale. Okay, clear? Same. Okay. So clear on how we got that 6,200? If you're using first in, first out. Okay, take note of first. So which means the first on that inventory will be the first that will be out. So that will be part of the cost of sales. Take note of cost of sales. For last in, first out, that's different. It will be opposite. So here, what will happen is, if we go back to that illustration, so the first item that will be should be out will be 400. Okay, so 400, and then you still have 150, right? Correct? Because you need 550, isn't it? To determine the cost of sales. So here, 400. How much is the cost of 400 there? 13 unit cost, and then 550, that will be 12. Okay. So this is first in, first out. Last in, first out. Okay. So let's calculate. So we have 413 plus by 1, and then 150 by 12. Total, that will be 7,000. Okay, clear? Last in, first out. Okay, so 7,000, is it correct here? Now someone will ask, how much is the ending inventory now? Answer, the remaining. So in last in first out, the closing or ending inventory will be coming from the earliest inventory. So 100, 200, and then this one is the half of the 300. Okay, where the half when that is part of the cost of sale is 100, 150. Okay, a while ago it's 300, now it's 150 only. Okay. For average cost, what you will do is you get the average. It's simple. Okay, so I'll just go back and show it to you. Okay. So normally what the average costing will do is get this total divided by this one, then that will be the average cost. Okay, and then if you're telling that we sold 550, you just have to multiply by average cost, that is 12, right? And that will be your cost of sales. So how much will it be? That will be 6,600. So this is the cost, right? Cost of sales. Cost of sales, correct? So if you notice, if you're using first in, first out, your cost of sales will be 6,200. If you're using last in, first out, 7,000. But if you're using average costing, that will be 6,600. Okay? Clear on this? Right. So how much will be the closing inventory? The difference between the cost of goods available for sale, which is 12,000, against this. So here the closing inventory will be 5,800. Here the closing inventory will be 5,000, and here that will be 5,400. Clear? So by changing or using different inventory methods, you may be able to influence how much will be the cost that you will charge for your goods sold, and how much will be the closing inventory, as you may have noticed there. So average cost, okay, as you can see, I've shown it to you here. Right? Cost of sales is 6,600. Is it correct there? So this should be what? All right. So what we'll do now is we will now try to determine the closing inventory using closing inventory and then cost of sales using first in, first out, last in, first out, and average cost. Okay.